we have already seen the initial measurement, and then there is subsequent measurement. Subsequent measurements, there are two models, cost model and revaluation model. When there is a subsequent measurement and using cost model, how will we value the asset? The cost minus accumulated depreciation minus accumulated impairment loss. And how will we do it in revaluation model? We will take the fair value at the date of revaluation and subtract any subsequent accumulated depreciation and subtract any accumulated impairment loss. So we will take the fair value as on the date of revaluation. And using cost model, we will take the cost of the asset and subtract the accumulated depreciation and impaired loss. And using revaluation method, we will take the fair value as on the date of revaluation and subtract the accumulated depreciation and impairment loss in order to get the carrying value of asset. So when do we have to revalue the asset? So revaluation model, the frequency of revaluation. If it is significant and volatile changes in the fair value, revaluation model, we see that we are taking the fair value. So if there is a significant and volatile changes in the fair value happens, then annual revaluation has to be done. If only insignificant changes in the fair value, then revaluation has to be done every 3 or 5 years. If there is volatile significant changes, then annual revaluation. If insignificant changes in fair value, then revaluation can be done only 3 or 5 years after, every 3 or 5 years. Now let's see how will we treat the accumulated depreciation. So there are two models, gross model and net model. In net model, we will eliminate the accumulated depreciation against gross block of asset. Let's see. Suppose we are learning about net model. Suppose there is a PP valued at 1000 and the accumulated depreciation is 400. So to get the carrying value, what will we do? PP, the cost minus accumulated depreciation, we get 600 as the carrying value of the asset. And then when we revalue, we see that the revaluation figure is 1500. So the carrying value of asset is 600 and when it is revalued, it becomes 1500. So there is a revaluation gain, right? A revaluation gain is 900 here. So in net method, how will we calculate how will we account for the accumulated depreciation? In net method, we will eliminate the accumulated depreciation. We will eliminate the accumulated depreciation. We will debit the accumulated depreciation and credit the PP. So to eliminate it, to net off it, we will credit the PP and debit the accumulated depreciation. The accumulated depreciation account debit, what it is, 400, and to PP 400. So we have eliminated the accumulated depreciation. And now there is a revaluation gain of 900, right? So that we will debit it to PP. So PP account debit 900 to revaluation gain 900. So in net method, we have to eliminate the accumulated depreciation. So accumulated account depreciation account debit to PP. We have to reduce the value of PP, right? Since it is a depreciation. So asset account credit. Accumulated depreciation account debit. Now there is a revaluation gain. The value of the asset increases, right? So we have to debit the asset. PP account debit to revaluation gain. So that is net method. Now there is gross method. In gross method, we will not eliminate the accumulated depreciation. Let's see what we do here. So the PP is valued at 1000 and there is accumulated depreciation of 400. What will be the carrying value of asset? 1000 minus 400, 600. And the revaluation, the figure becomes 1500. So the carrying value is 600 and on revaluation, you see 1500. So there is a revaluation gain of 900. In gross method, we will not eliminate the accumulated depreciation, but here first we will find the percentage of gain in the net block. In the net block, what is the percentage gain? How much gain occurs? What is it? The revaluation gain is 900 divided by the net value of asset is 600. So what is the percentage gain? Revaluation gain 900 divided by carrying value 600 into 100. 900 by 600 into 100, 150 percentage. There is 150 percentage gain in the net block. Now let's see the gain to the gross block and gain to accumulated depreciation. What is the gain to the gross block? So the gross block is 1000. The gross PP value is 1000. So there is a 150 percentage increase, right? So gain to the gross block is 1000 into 150 percentage 1500. And what is the gain to accumulated depreciation? Accumulated depreciation is 400 and there is 150 percentage increase. So 400 into 150 percentage is 600. Here we will find the percentage of net gain in the net block and will apportion. We will increase it in accumulated depreciation and all. So the PP account debit 1500 to accumulated depreciation, what is it, 600, and revaluation gain 900. So in gross method, the accumulated depreciation is not eliminated. Rather, the gross block and the accumulated depreciation is increased in proportion to the net block. We are not eliminating the accumulated depreciation. Rather, what we will do, we will increase the gross block. The gross block and the net depreciation is increased. We will increase the gross block and the accumulated depreciation in proportion to the net block. That's what we did here. We find the percentage increase in the net block. The percentage increase in net block is, there is a 900 increase. So 900 divided by 600 into 100, 150 percentage increase in the net block. So we have to proportion it to the accumulated depreciation and gross block. So we are proportionate to the gross block, 1000 into 150 percentage 1500, and accumulated depreciation gain to the accumulated depreciation is 400 into 150 percentage. We are proportionate it to the net block. So what is it? PP account debit 1500 to revaluation gain 900 to accumulated depreciation 600. That's gross method and net method. And next, revaluation to be applied to entire class of the asset. Suppose plant and machinery. In plant and machinery, there are 3 assets. The cost model is followed for 1 asset and revaluation model is followed for 2 assets. Is this a correct approach? No, because this approach is not allowed. If any item of a PP is revalued, then the entire class of which the asset belongs shall be revalued. If all these 3 assets in this class must be valued on revalued, if either one is revalued. So if any one item of PP is revalued, then the entire class, the class which it belongs, the entire class which the asset belongs shall be revalued. Now let's see how will we provide treatment of revaluation gain and loss. First let's see about revaluation gain. So if the gain, revaluation gain is first time, we are calculating a revaluation gain and the first time it is a gain, then we will transfer it to revaluation reserve. There is a revaluation gain, right? There is an increase in the value of asset. So asset account debit, PPA account debit to revaluation reserve. So if it is a first time gain, we will transfer it to revaluation reserve. Now if the subsequent gain, when we measure subsequent, this is initial measure and then there is a subsequent measurement done, and how will we account for the revaluation gain? So it depends on what happens previously. If previously it was a gain and then subsequent there is another gain, previously there was a gain and subsequently there was a gain, what we will do? We will transfer it to revaluation reserve. So when there is a gain and first time gain, then we will transfer it to revaluation reserve, and the second time is also a gain, then we will transfer it to revaluation reserve. But previously there was a loss. Suppose previously there was a loss and subsequently it becomes a revaluation gain. Previously there was a loss and next time when we revalued it is a gain. Then what will we do? First we have to, will we directly go to revaluation reserve? No. First we will adjust this loss. To the extent of previous loss, adjust the current year gain. So there was previous year gain and previous year loss and current year gain. We will adjust this loss first. To the extent of previous year loss, we will adjust the current gain. And if there is any remaining gain, we will provide it to revaluation reserve. Excess gain is credited to revaluation reserve. So this is about revaluation gain. Now let's see revaluation loss. If it is a first time loss, first time there is a revaluation, when first time revalued it is a loss, then we have to transfer it to the P&L. It is a loss, right? We have to, there is a decrease in the value of assets, so we have to credit to the PP and debit the P&L. P&L account debit to PP. Now On subsequent revaluation, what will we do? So first time there was a loss, we will transfer it to PP. And second time also there was a loss. First time loss, we will transfer to PP. And second time also it was a loss. What will we do? We will transfer the current loss to PP. So in both cases, we will transfer it to PP directly. But if previously there was a gain and subsequently there was a loss, at first there was a gain. First when we revalued, it was a gain. But then when we revalued, it becomes a loss. How will we treat? Will we directly go to P&L? No. First we will adjust the gain has been transferred to reserves, right? So we will adjust the gain. To the extent of previous year gain, we will adjust the current year loss in revaluation reserve. So this previous year gain was in revaluation reserve, and then there is a current year loss. We will adjust the loss to the revaluation reserve, and if there is any remaining loss, we will transfer it to P&L. So it's about revaluation loss. If it is a first time loss, we will transfer it to P&L, and second time also there is loss, we will transfer it to P&L. But if initially there was a revaluation gain, then we will transfer it to revaluation reserve, and subsequently it becomes a revaluation loss. What we will do? First we will adjust this loss with revaluation reserve, and then if there is any remaining loss, we will transfer it to P&L. This is how we will treat the revaluation gain or loss. Now, when will we transfer from revaluation reserve to retained earnings? If the life of the PP is over or when PP is sold, we will definitely mandatorily need to transfer from revaluation reserve to retained earnings. When the life of PP is over or when PP is sold, mandatorily transfer revaluation reserve to retained earnings. And if excess depreciation, the company has option to transfer excess depreciation from revaluation reserves to retained earnings. If we have provided for excess depreciation, then the company has an option to transfer it from revaluation reserve to retained earnings.